Are you torn between choosing a Roth 401k or a traditional pre-tax 401k? This decision isn't just about taxes today. It's about planning your entire retirement strategy. In this video, we'll dive deep into whether the Roth 401k is better than a traditional pre-tax 401k and when each one might make the most sense for you. With so much at stake, understanding the nuances could mean the difference between a comfortable retirement and paying unnecessary taxes. Both pre-tax and Roth 401k accounts grow tax deferred, but the way they're taxed is fundamentally different. Contributions to a traditional pre-tax 401k reduce your taxable income for the year, which means you pay less in taxes now. However, when you withdraw the money in retirement, it's taxed as ordinary income. Additionally, you're required to start taking distributions at the age of 72, known as required minimum distributions or RMDs. On the other hand, contributions to a Roth 401k are made with after-tax money, meaning you won't get a tax deduction upfront. But here's the key advantage. When you take the money out in retirement, it's tax-free, assuming you meet the age and holding period requirements. There are also no required minimum distributions if the funds are later rolled into a Roth IRA. Unlike the Roth IRA, there are no income limits for contributing to a Roth 401k. So, which is better? It really depends on your tax situation now versus what you expect it to be in retirement. If you're in the higher tax bracket now than you expect to be in the retirement, then it generally doesn't make sense to make Roth 401k contributions. For example, if your household taxable income is $500,000, you are in the 35% marginal tax bracket. However, if you expect to retire with a taxable income of $340,000, you would be on the top of the 24% marginal tax bracket for married couples. The simple question is, should you pay taxes now or later? The difference in tax rates can significantly impact your retirement savings. One common misconception is that many workers assume they'll be in the same or a higher tax bracket in retirement because they'll need the same level of income. But this isn't always true. For instance, generating $500,000 annually in pre-tax income for 35 years would require a $12 million starting retirement portfolio, which is not realistic for most people. Then there's a mega backdoor Roth strategy. This is a powerful tool for high-income earners, allowing them to max out pre-tax 401k earnings and then make Roth contributions up to $58,000 in 2021 or $64,500 if you are over 50 years of age. However, this strategy may soon be off the table if Congress passes a bill that prohibits it. Even so, if you don't need access to the money before retirement, a mega backdoor Roth could be one of the most powerful tax planning strategies available. Tax laws do change, and that's another factor to consider. The decision between pre-tax and Roth often needs to be revisited as your income situation and tax laws evolve. For example, if federal tax rates increase significantly in the future, or if you move from a high-tax state like California to a tax-free state in retirement, your strategy might need to shift. Also, avoiding RMDs by choosing a Roth 401k can give you more control over your tax situation and potentially help you avoid increases in Medicare Part B and D premiums. There are another tax strategies beyond the pre-tax versus Roth decision. This include annual Roth conversions at the beginning of retirement, qualified charitable distributions from an IRA deferred compensation plans, and net unrealized appreciation of company stock in a 401k. All these strategies can help you minimize taxes in retirement. One key principle to remember is the time value of money, which applies to the pre-tax versus Roth questions as well. Prepaying taxes means that money is no longer working for you. Compounded over time, this can be significant. Therefore, it's essential to discuss your specific situation with your financial and tax advisors. That's all for today. Thank you for watching the video. Please subscribe to our channel for more financial insights.